Today, we will talk about the top 10 stocks for millennials to invest in. The market's catastrophic crash had many biting their nails, wondering whether we're finally seeing the end of the decade-long bull market. Seeing the Dow Jones Industrial Average and the S&P 500 tailspin is unsettling. But if you're in your 20s, you should be applauding a market correction. 1. Walmart. If you grew up in the age of Amazon, Nasdaq AMZN, it might seem counterintuitive to buy Walmart, NYSE-1T. But Walmart's ability to survive the retail apocalypse and thrive in its aftermath should give you confidence in its future. The discount superstore is about to merge two of the most successful strategies to become a powerful and dangerous hybrid retailer. People love the convenience of shopping with Amazon, fast and free shipping, streaming perks, free returns. Walmart has got a lot of those perks covered now that the firm has built out its e-commerce presence. Now Walmart is taking a page out of Costco's Nasdaq Cost book with a new round of perks that will keep customers shopping at its physical stores as well. Walmart is reportedly preparing to roll out Walmart Plus, a membership that could include everything from discounted prescriptions to low-priced fuel at Walmart gas stations. 2. CVS Health. Another stock that's worth getting your hands on early is CVS Health, NYSE CVS. The firm has been under a dark cloud even before the market started tumbling because of the upcoming presidential elections. Not only could CVS actually benefit from worries about the coronavirus, as more and more people stock up on medical supplies, but the firm looks poised for impressive growth in the years ahead. Now that its Aetna acquisition is complete, CVS is a one-stop shop for all things healthcare. It's a retail pharmacy, a walk-in health clinic, a pharmacy benefits manager, and a healthcare insurer. CVS is no doubt going to capitalize on the fact that it can serve its customers at every point in their healthcare experience. 3. Waste management. When it comes to investing, boring is often best, and that's the case with Waste Management, NYSE. The company owns and operates landfills and waste collection vehicles, which it uses to carry out contracts with local governments. As the firm owns the landfills around the country, there's not a ton of customer turnover, which results in a fairly predictable revenue stream. Plus, although there has been a shift toward reducing the amount of waste the public produces, garbage isn't going away anytime soon. People will be in need of waste collection for the foreseeable future, and Waste Management will be there to deal with it. That's what makes Waste Management a great building block for a long-term portfolio. 4. Wells Fargo. The best part of being a 20-something is the vast expanse of time in front of you. That's true from an investment standpoint, which is why I think Wells Fargo, NYSE, is the perfect pick for a long-term investment in the financial sector. Wells Fargo stock has been down in the dumps ever since the firm's account scandal came to light back in 2013. Last week, the bank came one step closer to putting the ordeal firmly in the rearview mirror after agreeing to pay $3 billion in damages. On top of that, the firm has replaced its CEO and several board members and completely overhauled its employee compensation structure. As the bank emerges from this scandal, it could become a great value play. Not only that, but Wells Fargo offers a dividend yield just shy of 8%. 5. AT&T. Another stock I believe should be in every 20-something's portfolio is telecom giant AT&T, NYSE. The firm has been in the midst of a turnaround effort over the past 2 years and finally turned a corner during the second half of 2019. Although it gave Mac most of its gains during the crash, T stock has been marching quietly higher since April. Now, as 5G becomes a reality and the streaming space matures, AT&T looks poised to be a winner. 6. Apple. When it comes to solid, long-term buys with low debt and healthy cash flow, Apple, Nasdaq AAPL, is about as perfect as they come. The firm's cash-rich position means investors can hold on to shares with confidence as the company has the financial power to get through pretty much anything. Not only that, but a strong cash position during a period of economic hardship means Apple has the potential to buy up some of its less prepared peers. 7. Starbucks. Another investment that's been hammered in the wake of the coronavirus is specialty coffee chain Starbucks. NASDAQ. That's BUX. Some of Starbucks' future growth depends on China. So naturally, when the nation ground to a halt on coronavirus worries, the firm struggled. CEO Kevin Johnson said as much during Starbucks' first quarter results. But even without China in the picture, Starbucks looks like a good long-term bet. Starbucks' unparalleled loyalty scheme on a successful mobile app shows management's commitment to keeping the chain from falling out of favor among its customers. 8. Walt Disney. Walt Disney, NYSE is facing headwind after headwind right now as the coronavirus forces the firm to shutter some of its theme parks, and CEO Bob Iger announced his decision to step down. However, none of those events impact the long-term story for Disney stock, something investors can capitalize on now that the share price has dipped below $120. Last year, the firm rolled out Disney Plus, a new streaming service that by all accounts was bound to take the industry by storm. At this point in the coronavirus slide, Disney has more than given up those gains, despite the streaming service being successful over the past few months. 9. Berkshire Hathaway. Millennials have missed most of famed Warren Buffett's successful career as an investor. But they have the benefit of seeing in a new era for his holding company, Berkshire Hathaway, NYSE BRKA, NYSE BRKB. Buffett's infamous patience and restraint have made Berkshire Hathaway one of the best blue-chip stocks to hold on to. What's more, Buffett was holding on to a war chest of cash in the absence of great deals on Wall Street. That $128 billion is going to go a lot further now that the market is falling. 10. Alibaba. The building blocks of wealth are in slow, steady investments that appreciate over time. But in your 20s, there's room for risk, and that's why millennials should consider investing in China despite the chaos the coronavirus has caused. With that in mind, I believe choosing one of the safer Chinese companies is risk enough at this point in time. So Alibaba, NYSE BBA, is my pick. The Chinese e-commerce giant has a lot going for itself, including a top spot in China's retail market and a growing cloud business. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.